to serve the maximum amount of the market share, to reach the maximum number of the customers, we have to increase our production activity. Increasing the production activity in the way of arranging the additional machinery, arranging the additional equipment, additional facilities in order to supply the demand in the market. So for which you are going to invest the money. So while you are investing the money, you will have the like we will be interested to invest the money if you are going to have a stable demand. If the demand of your product is not stable, there may be some fluctuations during the demand period. Yes, by investing the additional money, you can encash that additional amount of the demand. But if there is any fluctuations in the demand during the no demand period, what all the money you have invested in the name of machinery or the equipment is going to become an idle investment, which doesn't get any additional revenue. So in those situations, as an investment manager, instead of owning the equipment and the additional machinery and all these things, better to have lease out, or better to have to take the lease, or to go for outsourcing, or to make an arrangement of the machinery or the facilities on rental basis. As long as you are having the demand, I think you can engage those things. You can make use of those facilities which were arranged on lease basis or on rental basis or on outsourcing basis. If there is no demand for the time being, I think you can close down all your contracts with the outsourcing or with the lease or with the rental. That is how you can avoid unnecessary burden in the form of payment of interest on your investment or maintenance of your owning of the equipment and all these things. That may be more economical rather than owning the things. So here you may have the decisions like make or buy. Is it more economical to make the things or to buy outside? When we will buy outside, the price at which the supplier is going to supply the things as and when you are buying is less than the price at which you are producing the things, where buying is more economical rather than making the things. Or own or lease. In some of the cases, take the machinery or the equipment on lease is more economical rather than owning the equipment. Hence, you have to take a decision which one is more economical. Or in some of the cases, it may be to continue or shut down. Continue of your production activity may be more costly rather than to shut down the things for the time being. So likewise, you'll have that various decision areas as an investment manager. While you are making use of these various facilities, that is how let you fix the responsibility of some of the individuals who are investing the money, maybe the financial manager or the investment manager, who will come across such type of decisional areas. So for which also, I think you need to examine, to monitor, or to supervise the various activities through which you can maximize the revenue or to minimize the investment burden. So that is how your investment center people are going to caution by way of attending these various decisional areas. Generally, how we are going to make them responsible for their activity in the name of investment centers, you have to measure their performance in the name of what is your expected return on investment? What is your ROI, return on investment? What is your expected ROI? What is the ROI you have attained? Suppose you have targeted the ROI of 12%, but the actual ROI what you have received is 11% or maybe 14%. because your target is 12%, the actual amount what they have earned is 14%. It's good. But suppose if they earned only 9% or 8%, which is a negative, because they are supposed to earn 12. They are supposed to have the ROI, return on investment, 12, but they have got only 8 or 9. They are not able to perform well, or the investment what they have made is not produced the expected results. Where you have to identify why they are not able to perform as per your expectation. So for which calculation of ROI is a parameter through which you can evaluate the performance of the investment center. So for calculation of ROI, you need two numerical values. One is the return. Return is generally in the name of profit divided by investment. Investment is the money what you have invested on various of your resources. So by calculating this ROI, you are able to identify whether they are able to discharge their duty perfectly or not. What is their performance? But for calculation of this ROI, you need two numerical values. One is the return, another one is the investment. What is meant by return here? Excuse me, 1 minute. So in order to calculate this ROI, it is a coefficient, return divided by investment. Where you will get this value of the return, in what form? So in your financial statements, you may come across the net profit or profit after taxes or profit before taxes, or so likewise you have different terms which you will come across in order to know what is the profit of the business. So this is going to be one of the value for the purpose of calculating this return on investment. So what is investment? So different versions which we can see in order to know what is this investment. Investment may be investment on assets, or the investment, the assets may be current assets or the fixed assets. What is investment? Is that investment is the total amount what we have arranged, both in case of the owner's money as well as the outsider's money, or we will consider only the owner's money, or by total amount, or can we consider investment is nothing but the total assets, the value of the total assets which is in your balance sheet. So here you will have different versions in order to say what is investment. So here, in general, investment means what all the amount you have invested on arranging the assets, both current assets as well as the fixed assets. That is one way of defining what is investment. That is nothing but the total amount of the value of your balance sheet, either on the left side or on the right side. If you consider the total amount in the name of assets, in such a case, your profit should be considered. That is, the net profit should be considered. Net profit after excluding all the expenses, what all the amount which is available for making all your assets to work for the cause of achieving this profit. That is what is ROI, return on investment. Investment means total value of the assets. Return is net profit what you have earned. So net profit divided by investment, that is what is ROI. And we can also measure what all the money have arranged, which may not be used in order to arrange the assets. There is some amount of the money which is unused. Unused means unemployed. If you arranged 1 crore, the whole 1 crore is invested on various facilities or the assets. That is full amount of the investment. That is completely employed. But in some of the occasions, you may not employ the total amount what you have arranged. You have arranged capital 1 crore, both from your own pocket as well as from outsiders, in the name of borrowed capital. But the whole amount of the 1 crore, you have not invested on assets. You have not purchased to the extent of 1 crore. You have invested only 80 lakhs and 20 lakhs you have not yet employed, you have not yet used. That is the amount which is deposited in a bank. As and when you want to extend your facilities or expand your business, there only you are going to make use of that remaining 20 lakhs. That 20 lakhs we can say they are unemployed. Since your total 1 crore is not used for the business, you should not consider that 1 crore while you are calculating the return on investment. So here, your investment is going to be in 2 forms. One is employed capital and unemployed capital. So there is another way of measuring the performance of the business, that is return on capital employed. Because you have actually employed 80 lakhs. Your performance should be measured only for 80. The remaining 20 you have deposited in a commercial bank where they are going to pay the interest. That is not actual your work. You have not earned anything on your own. You have deposited in a bank and where the bank fellow are going to be paying. That is not your efficiency. Your efficiency is going to be measured in the name of the amount what you have invested. That is only 18 lakhs. Hence, so in the calculating the ROI, it is more appropriate to calculate the return on capital employed. Whatever the amount of the profit you have earned should be taken as the numerator figure. Divided by capital employed. Capital employed means total investment minus unemployed amount. Unemployed amount is nothing but the amount which is not used for arranging of the assets. It is the amount which is deposited in the banks. That is how there is another version of calculating your performance in the form of return on capital employed. That is also one of the versions of calculating the performance of the investment centers. And there is one more version, that is in your total investment, you have 2 broader components. One is the equity, another one is the debt capital. Debt capital is outsider's money. Equity is owner's money. You may be more interested to know what is the return I am going to get on my money. My money means owner's money. So wherein the parameter is return on equity. So in case of return on investment, net profit is considered. Return on capital employed, profit minus of the interest earned on your deposits. Profit minus of, net profit minus of the income which is not out of our use of the assets, or use of the investment. There is some amount of the capital which is employed and unemployed. Unemployed money is in the form of interest. That should be excluded from your net profit. Because while you are calculating net profit, that is also included. And that included money should be excluded while you are calculating return on capital employed. Because here we have not considered the total investment. It is only a part of investment. To that extent only you have to consider the numerator value also. That is net profit minus of the interest earned on your unemployed money. Anyway, that interest received is available in your right side of the profit and loss account. That amount should be excluded. And the remaining amount only we have to make use in order to calculate the return on capital employed. But coming to this return on equity, having earned the net profit, you have to exclude several of the financial expenses. After that only, the amount is available in order to pay for the equity shareholders, mostly in the name of profit after taxes. Profit after taxes amount is available in order to distribute your shareholders in the form of dividend. Hence, PAT is the related figure in the name of numerator in order to calculate the return on equity. What I am trying to convey here, having fixed the responsibility on the shoulders of investment center, having entrusted their performance, its performance is going to be measured in the name of return on investment, return on capital employed, return on equity. These are the three parameters with which we are able to judge what is the performance of the investment center. So by fixing their responsibility in the name of this is the ROI, this is the ROCE, this is the RE. So having targeted the return, you can compare with the actual return what they have achieved. So by comparing these two things, you are able to know what is the performance of the investment center. As long as the investment center performance is good, that is, the actual is more than the targeted one, you can appreciate them. If it is vice versa, diagnose the reasons why they are not able to reach the targets, they are not able to achieve what the responsibility they have entrusted. There you have to find out the reasons and try to rectify those things so that you can do your business effectively. So this is what the role of investment center and the people who are responsible in order to attend the investment process of the organization. So by knowing these three, that is the return on investment, return on capital, and return on equity, I think you can judge how the investment center is working for the cause of attaining the maximum benefit to the business. So apart from this, I think there is one more parameter, that is economic value addedness. That is nothing but the residual income. Residual income is the income after meeting all the expenses, the amount which is available for the business in the name of for expansion of the things or for extension of the activities, or the amount which is going to be retained in the business. That is what the residual income. After meeting all the expenses, the left out portion is going to be named as the residual income. So this is another parameter with which I think you are able to judge the performance of the investment center. So this is the economic value addedness approach. What the actual amount of the economic value. So here you may also take a note of the inflation. Though you are earning the numerically, but what is the actual amount of the money you have earned? So for that, you have to make the adjustment of this inflation also. Though you are able to earn some 12%, but where there is a inflation, I mean the loss of purchasing value of your rupee, say for example 4%, your actual amount of the value add is 12 minus of 4, that is only 8%. So by excluding this inflation effect, to that extent, you have to make the adjustment with your numerical value of the benefit, what you are going to be received. That is what the economic value addedness for your business. So these are the things which we should calculate for the purpose of knowing the performance of your business by entrusting the responsibility to the various investment centers. Anyway, your supplied material is having a lot of the discussion on it, and it is very user-friendly. You can go through that material so that it will be having more clarity for understanding of what this investment center and how the investment center is going to contribute for the well-being of the organization. So for which I think you have different versions of ROI, ROCE, and RE, that is return on equity, and also to know the economic value added, that is the residual income in your business organization. So with this, I think the discussion on investment center is over, and you have more elaborated material. Completely one unit is on this investment center. Please go through it, and you will also having in your material, there are several numerical illustrations. Please go through them. There is no difficulty at all. It is very user friendly for your preparations. Please go through it so that you will have more clarity over on this what is this investment center, what is the concept of it, and how it works. How do we measure the performance of the investment centers by taking the several numerical examples. So with this, I think this investment center topic is over from our discussion. And here is also there are various other ways of knowing the performance of the investment centers. The main object of the investment center is to maximize the revenue, to maximize the profit. How do we maximize? How do we make use of our more amount of the income to the business? So this is what this investment center discussion. So having completed the investment center discussion, then we will go for another concept that is transfer pricing and control. How do we control the transfer pricing? Concept. I would like to discuss where it will come into our picture. What is the relevance? What is the context in which we will come across in case of a multi-product organization or a multi-branch organization or multi-sections, multi-departments. If you are going to produce only one product, in such case, I think the question of transfer pricing question doesn't arise. You are manufacturing, let us take for example, some 3 or 4 products in your organization. As and when you are manufacturing 3 or 4 products, or in 3 or 4 branches, or in 3 or 4 countries, you will have the multiple products, multiple branches, multiple sections, multiple departments, or multiple locations. As and when you are having this sort of a setup, the inputs of A is going to be purchased from different suppliers. You have processed it. You will get the output from your product A. This output is going to be the input for the product B. That means for product B, you are not going to arrange the things from outside the organization. One of your sections, one of your departments, one of your branches are going to supply the inputs to your subsequent or next department, next section, or next product. Product A is producing some material that is going to be the input for the product B. The finished product B is going to be the raw material for product C. Likewise, there is a continuous process of your own material is going to be used as the input material to the next product or to the next branch, to the next department. As and when you are having this sort of a process, the end product of one department is going to be the input for the next department or next product. Then the question of transferring price arises. At what price you can supply the end product or the finished product of A department to as the raw material for product B? At what cost? If you are going to purchase from outside, in such a case, the price what you are going to pay to your suppliers is going to be the material. That is the cost. But here, you are not producing from anybody. You are not arranging from anybody. You are one of the departments is going to be the supplier. If you are going to pay from your pocket, you can say, what this is the price, this is the cost at which we are incurring for arranging the material, or at which you are supplying the material for so and so price. Since you are the both as the customer, you are supplying to one of your branches. At what cost you are charging? At what price you are selling your next baby? That is where I think this transfer in price concept arises. So here, at what price we should supply to your next department? At what cost we should charge? If you are going to take the end product of one department to as input to the other department, the problem before you is at what price should I supply to your next section, which is going to the income to the previous department. The end product of B is going to be the input of C. The product B should arrange its accounts. What is the income it earned? What is the income it earns? So for every department, you have to settle the accounts. So for settlement of their individual accounts of these departments, you have to charge at what price you are going to market your product from A to B. Unless you will have the very clear terms and conditions for charging of the end product of one department, which is going to the input of the other department, you cannot make them responsible for given targets. The product A should also work very well. Product B also should work very well. Unless every department is going to contribute equally what they are supposed to contribute for the overall performance of the organization, you cannot achieve your overall objective. So for which at every branch level, every product level, you have to make your own accounting. Now the problem is at what price we should supply from A to B, or at what price the B should purchase in the name of the cost from A. So that is the case where this transfer pricing policy or the transfer pricing concept will come across. If the A is going to supply at an open market price, suppose if the B is supposed to arrange, it can purchase from outside the business also in the open market. If the open market price is 16, if that A is going to charge at 16 rupees, if the A is prepared to charge at 16 rupees, okay, it will get good amount of the business. But why should I purchase from A only when the same price is for the same price, the material is available in the open market? Yes, I can purchase from anybody. Why should I get the things from A only? That is the thinking of B. If the A is going to have some soft corner, some consideration to supply less than the market price, yes, B may have an advantage. B may have an advantage to get the things from A. Okay, since the market price is 16, by supplying at a concession rate to B, what is the benefit I am going to get it? That is the thinking process of A. How you are going to resolve? How you are going to resolve? So this is the issue. At what price should I supply? What price should I accept? So this is the case of this transfer price. And here there are different types of the pricing policy which you have to follow, and you have the pros and cons of different prices. Anyway, as a business manager, you should give a trade-off between both the departments. You must see the welfare of both the departments. If you ask to supply only at a fixed rate, a fixed identified, because If I am going to market my product in the open market, I may get 16. Over the open market, the B may not be interested to purchase from A. So this is how there is some sort of a trade-off should be find out as a head of the organization, just in order to satisfy both the sections of your business. So here you must identify what are the objectives of my transfer policy. So the objectives of the policy must be, you must evaluate the current performance and the profitability of all the units with equal justification. And you must try to improve the overall profit position of the organization. And you have to give the equal weights, either to say you have to supply to B, or while you are asking the B should get only from A. So this is how I think you have to make a trade-off between these two departments to supply the things, and where I think you have to assist both the departments in order to take decision making. And also you must estimate the earnings on proposed policy of transferring both the departments of A and B. And you must also allocate the equal preferences while earning the profit of both the A and B. And you must have an independent decision making in order to satisfy the needs of both the departments. So with that object only, I think you have to set your transfer price. And while you are giving your direction to these two departments, you have to evolve a method of what is the price at which, what is the method of price they have to follow. And while you are making them come together, both of them must be having the competency in the market, and the relations must be very congenial relations with both the departments, and there should be some good atmosphere. And to the extent possible, you try to justify both the departments. And you should also give the full information regarding what is the cost for manufacturing and what is the price which is available in the outside the market. At what price, I think it is more amicable and beneficial to you, while you are suggesting to the buyer of the product of one product to the in the organization. So you must pay your attention to make the justice for both the sections of the both the departments or both the products of your organization. But now we are going to discuss the different methods of transfer pricing. One is market based, completely market based. That is one way of following. If it is a market based, and both the people come together and they should discuss. If it is market based, the receiver is not happy. In the purchasing from my own one of the wings of the organization, I can as well get from the outside, and you may have a better terms and conditions also. But while you are supplying the things, why you are more interested to supply only for market price? Because if it is going to be outside the organization, here the question of when you are going to pay, how you are going to pay, and you may have the confidence on your buyers or not. You may have some amount of the the bad debts also. They may ask some amount of the discounts or the concession or the time lag and all these things. If it is going to be one of your wings, you need not pay and he need not accept. Both the things are going to be settled at your center of the organization by making simple adjustment. You need not literally pay to the A and you need not literally receive from B. And both of your accounts are going to be make an adjustment entry in the central office of the organization. That is market based. That is one type of transfer, market based. If it is going to be an increasing trend, in such a case, better to follow the market based. Every day, the market price is going to be increased. In such a case, what all the price at which they have agreed based on the consciousness of the market, yes, it is beneficial for both the people. Because tomorrow the market price is going to be more than what the market price of today. So in the event of an increasing trend in the market, So better to follow this market-based transfer price. Another one is the market is highly stable. There are not very much fluctuations. So then you go for cost-based. Whatever the cost I have incurred in order to produce this should be charged to the receiver of the product, because there is not be any much change in your market trend. So better to follow the cost-based. Or you may have a dual transfer price. Dual transfer price means for up to certain extent of the quantity, you have to follow this price. If you want to get more than that quantity of the material, then you can go for an incremental price. That means instead of following a single price, I think you can have two types of the prices. One is the price at which we are going to supply, keeping in mind the receiver welfare. And another one is keeping in mind the supplier. I think you may have a higher than the earlier price. That means there are two slabs. One is the lower slab, another one is the higher slab. So that is how, instead of taking a single price up to certain quantity, one price. Beyond that quantity, I think we are going to have a little bit more price. That is how we are going to, I mean, the consumer by following this dual price. And another one is negotiated price. I think from time to time, I think we are going to have the negotiations. So by sitting there, I think one is the bargaining, another one is going to say yes or no for that. I think through the negotiation, we are going to settle the price for transfer of the material from one section to another section. So this is how I think you may have different transfer prices while you are having the transfer pricing policy in your organization. So for every type of the price, method of price, you have the merits and the limitations. So in your material, I think it is very clearly presented that you go through the advantages and the limitations of different pricing methods of this transfer price. So this is what is transfer price. The transfer price is nothing but it is the material which is going to be supplied from one department to another department of the same organization. While you are transferring the material from or supplying the material or arranging the material from one section to another section, and both the sections are of your babies, you must take the welfare of both the people, not to exploit the supplier to the receiver, or not to exploit the receiver from the supplier. I think you have to have some sort of a gentle amicableness between the receiver and the giver, because both the things are going to be ultimately contributing the overall profit of the business. Even one department is losing, I think it is going to be automatically having the benefit to the other department. Anyway, the other department benefit is the overall profit of the organization. And ultimately, you are not going to be affected any of the performance. But while you are judging one is going to be having some sort of a feeling, I am not going to earn that much of the profit. I am underperformed. With your underperformed, you are not able to appreciate the caliber, appreciate the amount of the work of our department. So here, there is some amount of the unjustification with respect to evaluate the individual performance, where I think you have to take proper care in order to make them equally good or equally contributing for the overall performance of the organization. So for which I think the transfer pricing is very, very important to follow as a policy while you are fixing the price from one department to pass on to the other department. So here you have market-based, cost-based, negotiated, and dual price. So there are all the different types of the transfer prices which we used to follow in any organization whenever you are having the transferring of the material from one department to another department. And here you have 4 methods. Every method has its own pros and cons. So let you go to that material so that you will have more clarity over which method is more amicable, and what is the advantage and what is the limitations. And here you may have given some numerical illustrations also. How do we calculate this different methods of the transfer price? So it is also over. And while you are following this transfer pricing policy, you may have some amount of the difficulties or the issues which you use to crop up, and in between the supplier and the receiver. These are the types of the problems which you come across. One is there may be some disagreement between these two, and the other fellow, since you are not going to give any amount of the consideration in the purchasing from you, I think I can as well go and have it from the outside the market. That is how I think there may be some, I think a difference may arise, and that difference you have to resolve. That is one of the areas where there is some sort of the differences in their opinions. And in some of the cases, the issue may not be resolved because you are going to look at as an independent and autonomous these sections. While you are judging the performance of these sections, I think they are not going to compromise. In one way, I think you are insisting them to supply at this price. In such case, you cannot ask them to do at this rate of the performance. So that is how I think there may be some divisional managers are not happy with this sort of the arrangement. I think there may be some disagreement between the managers of different departments. And here, I think there may be some additional cost, time and manpower will be required to execute the transfer prices and designing of the accounting system also. Even while you are saying this is the price at which you have to calculate some of the calculations, for which I think you need some manpower. Unnecessarily, you are using the lot of the discussion and lot of the man hours consumed for settlement of the things. That is also a burden to the organization. And some of the cases, I think you do not work equally for the welfare of both the departments, because at one end, you are asking, this is the price at which I am ready to supply. And you cannot ask, no, let you supply at this price. So that means just you are not accepting, you are not taking into account the welfare of that particular department. And there may be some biasness as and when you come across this settlement of the transfer price. That is also one of the issue. And the transfer prices in multinational companies is highly complicated. Multinational companies, that means at one branch in one country, he is going to supply the material to another branch at another country. So it is across the nations where you will have the problems like the transport costs, the taxes of the government, and the transfer of the material from one country to another country, where you will have different types of the tariffs. So by including all those things, I think this may not be work out, this transfer pricing and the settlement of the things. Hence, you may have some problems while you are arranging this transfer price model. And besides these things, I think you may also have technical issues in the sense customs problems, excise duties, sales tax problems, octroi problems while supplying from one section to another section. And likewise, I think you may have the different rules also, because you are dealing in different states or different nations. I think the transferring the material from one nation to another nation, one state to another state may also cover the different, wherein I think it may not be amicable for you. And there may be some conflicting objectives of the different organizations also, different departments also. Your objectives may be different to the objectives of other departments. And the government regulations like the state rules and the central laws and all these things should also be take some sort of a technical difficulties while you're following these things. If it is going to be across the nations, import regulations, those things also I think you must take a note of it. But anyway, these things can be resolved through negotiations of the organization. Your administration to take the negotiations. Through negotiations, I think you can resolve many of the things. And if there is any conflict between the departments, while you're supplying or while you're asking things, I think let us go and resolve through the conflict resolutions or through arbitrations. And also, you must have the clarity over on and whose welfare you must protect. Even though you are having two kids, generally the younger kids needs some amount of support because of the age, because of the lack of the experience, or because of not having that much of the experience in the business or the exposure of the environment. So because of that, even in your families also, I think we used to give some additional support to the younger ones because of their underprivileged or because of their disadvantage in terms of the experience or in terms of the age, in terms of the maturity. So likewise also here, between your two departments, I think you must support the department which needs really the support. And if necessary, I think you may be a little bit harsh towards the elder ones or the people who are having some potential in way of doing the things more than the other one. So this is how you must take a stand in order to resolve if there is any conflict arises between the departments while you are following the transfer of the material from one department to another department in the name of transfer price. So with this, I think this unit on transfer price is also over. So in this, so with this, block 3 is over, and we will go for the next block in the next schedule hour. So with this, I am going to close down my discussion. If you have any further clarity or the things which you want to make my attention, you are most welcome, and I'm going to ready to explain these things if at all, if anybody wants to ask anything. Okay, and here there are only two students. One is Fatima and Kumar Swami. Are you okay with this?
Yes, sir.
Hello?
Yes, sir.
Fatima. Is that Fatima is not here?
Sir. Yes, sir.
Hello?
Hello. Hello.
Swami?
Hello, sir. Voice is breaking, sir.
Okay.
Network problem.
Shall I stop my discussion or you want to ask anything? Okay, shall I stop my discussion?
Yes, sir.
Okay,
Yes.
shall I wind up? Shall I
Yes,
wind
sir.
up?
Yes,
You
sir.
want to ask anything? Okay, there is some network issue. Okay, it's okay.
Okay, sir.